So today, Joe Beatty will be leading this discussion. Joe is a member of our programs committee, and he will introduce all of our panelists. So thank you so much for coming. Thank you, Joe.
Thanks again. It's a good turnout today. Thanks for the turnout, and we appreciate you coming out today for lunch. This is part of our Asset Owner Series, second event. First was last year, and the whole focus is a conversation as far as institutional investing, what asset owners are doing currently, family offices, institutional consultants as far as their thoughts on the world. And with that, let me introduce Emily Hylton and Chetan Grover with Aon Hewitt in the Atlanta office. Also joining us is Barry Berlin with Cibc Private Wealth. Brad Gates, CFA, Director of Private Markets for Southern Company Services, also known as Georgia Power, and you probably see that at least once a month. And also Grace Moore with the Georgia Tech Foundation. Grace most recently joined the Georgia Tech Foundation from UPS, where she worked in the pension area there, so she has a unique perspective as far as service of two different asset owners. Let me just start off the conversation, first of all, because it's probably where we all start our conversations, either internally or with clients, and that is just literally current trends in asset allocation and risk management. Bruce, let me start with you. You come from an environment where you used to have actuarial assumptions you work with, now you've got spending policy. Share with us a little bit as far as what process you go through at Georgia Tech as far as developing asset allocation guidelines related to how you're spending money.
Yeah, sure. So first of all, thank you for everyone for having me here today. At the Georgia Tech Foundation, we follow a spending policy, and that spending policy is determined by two factors. The first is asset value. The second is the payout ratio. The asset value is calculated as the past 12 quarters average asset values. So at the endowment is all about permanent capital, and how much we should spend. So we reconcile our spending rate with the expected return. Given that we cannot really control how much asset value we have, so we control the payout ratio. We have lowered payout ratio in the past decade or two, given the lowered expected return from the market. For example, our expected return, our payout ratio was 6% back in 2001, but we have lowered it to 4.89% today. And then in terms of asset allocation, we have this IPS. Is that something I can get into today?
Sure.
Okay. So we have this investment policy statement just like any other asset owners. And that IPS pretty much defines the risk we want to take. Our investment committee reviews the IPS once a year at least to make sure that we are capturing the risk that is the most suitable for the foundation at the time. And we have had a very equity risk-centric portfolio for a long time. Our combined exposure to public equity and the private equity has been around 60 to 70%. However, we are in the process of changing that given the late cycle environment that we are in. So in terms of how we are going to implement it is we are going to reduce the equity exposure for the public equity from 42.5% down to 35% and increase the liquid alternatives from 20% to 35%. And there are some leverage from futures that are involved so that we can achieve some capital efficiency by releasing more cash to liquid alternative active fund managers, while also keep exposure in our public equity and the fixed income book.
Let me apologize to the audience for something that I wanted to do and didn't. And I'll start off with Grace to do this. Just a brief description of your environment at Georgia Tech and describing the investment office there. And I apologize to the panelists for not doing that first, but we'll just kind of shift gears a little bit.
Oh yeah, no problem at all. Yeah, so as Joe mentioned, I represent Georgia Tech Foundation, which is the endowment for Georgia Tech. The foundation was founded back in 1932 with $406. Fast forward, yeah, very small. But fast forward to today, it's a $2 billion endowment fund that provides financial assistance to Georgia Tech. These $2 billion assets are invested across 5 different asset classes, including public equity, fixed income, liquid alternatives, real estate, and private equity. We also own direct real estates that are deemed strategic for Georgia Tech. For example, the Georgia Tech Hotel on Tech Square and the Biltmore. There are about 35 people working at the foundation, including the investment team that manages the portfolio, as well as IT and accounting functions. This investment team was expanded to 9 people from 5 back in Q4 2018. So this is a relatively new team, but consists of experienced investors from Georgia Tech Endowment, UNC Endowment, Emory Endowment, and UPS Corporate Pension. In terms of my own background, as Joe already introduced, I joined from Corporate Pension and I'm new to the foundation. It's about 5 months so far. I run the equity book for the foundation. I'm also a long-time volunteer for ASFIP, so I'm really glad to be here today, and I'm looking forward to learning from the rest of the panel. Thank you.
Thanks, Grace. Brad, why don't we take a minute and talk about your team at Southern Company?
Sure. Thank you for having me here. We have a pretty lean team at Southern. We have eight folks that manage the assets of the pension, the 401k investments, nuclear decommissioning trust at Georgia Power, various foundations as well. All told, it totals to about $20 billion of responsibility for our oversight. We do have a consultant that we call upon and utilize on retainer. That's Mercer. We've been working with them now for 4 years. And so on the public market side, we get pretty heavily involved there with them. On the private side, it's kind of a mix of our team and their ideas, if you will, and their access to managers. We do an asset liability study. We're pretty boring. We do an asset liability study every sort of 5 years or so to determine our long-term approach to the markets, and we do take a very long-term approach because our pension plan, unlike many others, is still active and open and fully funded. We're about 100% funded. So that's kind of a lay of land on the pension side, and then like I said, we have these other pools of capital that we manage as well.
Our company, Cibc Private Wealth, is a national company. We're owned by a Canadian company. We have 500 or so employees in the lower 48 and a dozen or so offices. We manage about $55 billion, 90% private client wealth, and around 10% foundation and endowment wealth, and hundreds, if not thousands, of clients around the country. I was asked to be part of this today to represent family offices. Sometimes firms like ours are characterized as multifamily offices because of the services we provide for very large clients, and very often we're in the business of providing a rifle shot investment program or two into family offices where we might just have a sleeve of those investments. I'm very curious to know if anyone in the room is either a principal or staff of a family office here in Atlanta. There are quite a few family offices here, 30 or 40 I would project. They are quite idiosyncratic. You've seen one, and I read in a report this morning in the trade press that one consulting firm or publishing firm or another was targeting the single family office or SFO market, and they think there are 5,000 such offices, if not around the country or around the world. So it's become a viable segment. I wouldn't characterize it as an institutional segment. These are taxable investors, and problem solving is probably primary in many family office minds as opposed to investing, which could be a secondary consideration. But nonetheless, here we are, and happy to be part of this today. Thank you.
Barry, to just kind of echo that, when we first tried to determine a family office to be part of a panel, it was like looking for the invisible man. The feedback that we got was that there's nobody from a single family office that would stand up in front of a crowd and tell you what they're doing or how they're doing it. So, in conversing with Barry initially, his comment was that there's probably about 30 family offices in the greater Atlanta area. Cibc works with about 15 of them. So we thought that Barry would be a good proxy for family offices and what they do.
And they're very private, so I'm going to wear these just to make the point.
Mr. X, let me turn it over to Hewitt to tell us a little bit more about their practice.
Sure. Good afternoon, and thank you again for hosting both Emily and I. We are around the corner in the Atlanta office at Hewitt Investment Consulting. The practice has been around for quite some time. It's been through quite a few different evolutions through M&A in the business. But the overall presence for the U.S. practice is north of 350 associates. When Emily and I joined the practice a little over a decade ago, at least in Atlanta, we had around 10 or 12 associates. We've quadrupled that, very much matching the trajectory of growth nationally as well, and globally north of 900 associates. We do have a few of our colleagues here in the audience as well, so thank you for your support also. Just a quick background, I've been in the business almost 13 years and have had the pleasure of partnering with Emily and a number of my colleagues here and across the offices. And we do advise to a number of different pools of assets, primarily in the institutional space, pension, 401k plans, endowment foundations, and some of the examples we'll share with you today directly come from our experiences, one more as recent as yesterday that Emily and I have partnered on. So, Emily, if you want to introduce yourself as well.
Sure, Emily Hylton, and as Chetan noted, I work in the Atlanta office. So, Aon Hewitt, for those of you that aren't familiar, we have about 2.3 trillion in assets under advisory and about 160 billion in delegated assets. That's sort of outsourced CIO function. We have in-house manager research. That's almost 140 individuals globally. And then, as Chetan mentioned, we consult to pretty much all client types. So ourselves, we focus a lot on DBDC. We focus in the nonprofit space, 403B plans. Gotten a lot of notoriety recently in the press. For litigation, that's an area of focus for us as well. So as long as it's an institutional pool, it could be considered a client of ours.
While I've got Aon Hewitt kind of activated here, why don't we go back to the first question that we had with Grace and talk a little bit more about your all's practice area and what you're seeing as far as the asset allocation process with your clients, and if it's more asset allocation or risk management at this point.
Absolutely. So we'll try to give you a consultant answer, which almost always starts with two words: it depends. And certainly depends on what the pool is. But we'll try to provide some context around what Grace and Brad talked about. So when we talk about, for example, pension plans, asset allocation has evolved materially over the last 10, 15 years. At least we've seen it, and certainly a lot more we've talked about over the last 20, 30 years. The risk management has become key. And if you see the various headlines come across your desk, with certainly pension plan pools, there has been a mass movement towards minimizing that liability on your balance sheet. And how you do that can be done in many ways, looking at your asset allocation, but a particular focus has been in the evolution that we've seen, whether it's looking at a glide path in the allocation between risk seeking and risk reducing. But more importantly, more recently, we've seen a pretty important trend towards looking at what type of risk reducing assets you have in the plan. So it's not just allocating to long bonds, but also looking at whether long bonds, whether it's government or credit, and then how you have a strategic plan in looking at the duration of the assets, or of your fixed income assets that you want to target. To give you the other hand equation, when you look at non-pension plans, particularly the example, Grace, you shared about endowment foundations or those types of pools, there was an exercise. Evan and I are fresh from our trip yesterday with a foundation where we looked at their asset allocation framework and whether it helps meet their spending policy needs, call it 5% real. That's also evolved, so it's certainly not hitting the ball out of the park, hitting home run type of pools, but really looking at that risk-adjusted return. Yes, certainly you can put a lot of your money in equities and public REITs that will get you there, but it's also looking at whether we can modify the allocation to include more alternatives, private core real estate, equity insurance risk premium to help diversify your pool, but also reduce that volatility, because we have certainly seen an uptick in volatility just if you think about the last 6 months. So pretty interesting discussion we had with the client. More follow-up for us, but that's been the trend.
Thank you. Barry, what do you see on the family office side as far as asset allocation trends, or if risk management is a more important conversation?
Family offices very often have a core asset or two that is an anchor in their allocation. So if you think of the Brumley family, that was the Zeiss family office here in town, so closely associated with Berkshire Hathaway. If you think of the Home Depot founders, 2 family offices in town at least that are so associated with one stock, on and on. Very often the asset mix of everything that's not that core asset would not look necessarily like a typical pension or endowment or retirement plan. It's often an effort to balance risk. If a family has a concentrated asset and it's a fairly lofty PE these days, and maybe a cyclical company enjoying peak earnings, then there's an effort to offset that risk throughout the portfolio. That might be through alternatives, although I would argue that the fees you pay to manage volatility aren't worth the fees you pay to manage volatility, and through other asset management means. Finally, I would say that family offices typically are fairly active, not just in risk management around that core asset, but in developing better returns. It could be writing calls. It could be using those securities in swaps, in exchange funds, as the basis for exchange traded notes and the like. So there's a lot of creative solutions out there that allow a family to continue to hold a significant portion of a concentrated asset that they typically know and love, but we're able to branch out into further diversification as well.
Your thoughts, Brad?
We have, like as I mentioned before, we have various pools of assets. So it depends on the pool of asset how we manage that. Each has its own liability stream, and that's what we focus on to try to obviously fund that liability stream. For the pension in particular, with the open active pension plan still, our liability is growing about 7%. So that without requiring contributions from the company to fund that, which we like to try to minimize, we have to try to achieve a return on a long-term return in excess of 7%, which calls for a significant amount of equity exposure. We are 77% return seeking, if you want to call that. The real estate portfolio is about 14% of that 77. It's fairly conservatively invested, generally speaking, so it's not quite as equity heavy as it seems, although that is considered equity still. So that's kind of the approach we've taken on the pension side. we looked at strategy every 5 or 6 years or so, and just kind of keep tabs on it, but we tend to make changes more incrementally, but at the same time, as our liability changes, because we implemented a cash balance formula for new hires, so over time, our liability growth will slow, and as our funded status improves, just through market returns, because we expect to earn a little bit in excess of the required rate of return. As we get to better funded levels, say 115% or so, it starts to make sense to start shifting some assets into the long duration fixed income piece of the portfolio, which is 23% of the portfolio today. So that's a liability hedging mandate for that portfolio. So as time goes on, we'll be shifting more assets into that portfolio. But I can imagine we'll always, as long as we have an open plan, we're going to have a growth rate that is meaningful, which will require still meaningful equity exposure, and we do implement through both public and private markets to try to achieve that return.
Let's stay with you for this next question, Brad. Active management, the trends that you might see with the employing of active managers. Is active still relevant?
Yeah, for us, active has been very successful over a long period of time and over rolling periods of time, because any one given rolling period may not look as good as another. But we've been very successful with our approach, but passive still plays a role in the portfolio, so we have a mix. And I think this will be perhaps a later question, but we're even tweaking that passive piece some here in somewhat response to the market environment we're seeing. So, I think active management plays a role. It has, there's better spots for it than others within the portfolio, and we try to identify those areas where it can make more sense and deploy it there, and have active management around the fringes. And we have a very regimented rebalancing program in place as well. And why I'm mentioning that is because there are advantages in our portfolio. I did a study 8 or 9 years ago, looking backward and forward, just the best we can do that, and looked at the active versus passive question, and actually the result of that study was that for us it seemed to make sense to have both, because some will, active will outperform, and sometimes, and other times passive will outperform, and they do have cycles, and so that creates rebalancing opportunities and ways to capture alpha that way.
Barry, tell us a little bit about active versus passive as it relates to the family office area.
Not too sure there's a generalization that applies to family offices. Many family office managers, particularly if it's a small family office with a principal and 1 or 2 staff, they want to simplify their lives and free up their time for problem solving, for working with the multi-generational client or family that they're part of or very close to, and working with that elephant in the room asset that we described earlier. And so very often they'll use ETFs or index options for those parts of the portfolio where their incremental sweat equity in identifying and tracking, keeping up with managers may not be worth their effort to do because their hours in the day are so limited. And so I think we see quite a bit of indexing across the fairly typical categories, fairly typical market categories, and less so in some of those categories where one might expect to find alpha. And I think that's probably true in your environment, in yours as well. Thank you.
And any comments from Aon Hewitt as far as active managers and if active is still relevant?
Sure, I can take this one. So similar to Barry, we don't have, and Brad too, we don't have a clear-cut case on active versus passive. It's very client dependent. So think about a DC plan, for example. If you have a small DC plan that can only invest in mutual funds, and you're really consciously focused on risk management, and that risk is the risk of getting sued, you might prefer an all-passive lineup. You're providing your participants with functionally access to beta in different market sectors, but you're not taking the risk that you're going to have higher fees or that those funds are going to underperform. Within other institutional pools, endowments, foundations, or pension plans, we prefer, from I think, philosophical perspective, in even some traditional areas where you might see passive management, such as equity, even U.S. equity or global equity, that broader mandates that are higher conviction, we believe will outperform passive over time. And I think there's a key criteria here, and that time limit is not the 3 to 5 years that folks such as myself have been quoting for a long time. It is a long-term time horizon, so we're looking at 7 to 10 years, because any manager is going to go through a performance cycle. So I think Brad and Grace are very long-term investors, very naturally with his client base. They're almost forced to be long-term investors in their particular security or concentrated security. Most of the pools that we consult with are very long-term investors too. So when we think about employing active management, if you cannot meet that criteria, or the investment committee cannot meet that criteria for 7 to 10 years for active management, it does kind of lend itself to considering passive management in certain asset classes. There are other asset classes where passive management is just, it's less efficient. So fixed income has very specific buyers in certain segments of the market that create anomalies in the market. So indexing certain of those segments is not the most efficient way to access that market. But that being noted, we've seen, I'm sure you all with large institutional pools have seen the same, to the extent that passive management is used, we've seen fees in a realm that I've never seen in my career. And it's generally quoted for very large pools under a basis point. So that's not something that I've experienced over the past 15 years, 20 years. So fees are coming down, and a lot of managers are using that to effectively help retain assets with a particular client.
One follow-on question, Emily. Last year, a comment from one of the consultants was that there are boards of trustees that active management just isn't a fit with, just because of the variability of return and the point that you might have 2-3 quarters where certain managers might be underperforming. Can you speak to that from the trustees' perspective or from the board's perspective, as far as certain boards maybe being more receptive or less receptive to active?
Yeah, it comes back to this concept that you mentioned in the first question, the idea of risk management, right? So your board or your investment committee knows your organization well, and they understand where the risk hopefully resides. And if that risk is the risk of liability, then it might make sense to be more passive. I think what we do for different pools, so board of trustees maybe equates to an endowment foundation. And that type of pool, if the board was set on using passive management, I think we'd go back to this concept of an active risk budget. There are places in which it is much more efficient to use active management. And to Barry's comment earlier that some of these volatility reducing strategies aren't worth the fees that you might pay, we believe in paying for skill. So if you cannot pay for skill, shouldn't employ active management. There's no sense in paying for beta, right? I mean, a lot of hedge fund managers got into trouble with that. It doesn't make sense to have them holding 40% to credit, 40% to equity beta, and then what was that, 20% to diversifying strategies, and you're paying 1.5 or 2 and 20 for that. That makes no sense. So I think you have to, when we bring it back, and look at the entire portfolio. So not simply one segment, and you can be passive in certain segments, but that could allow you, from an active risk budgeting perspective, to effectively take more risk in alternative segments or liquid alternatives, et cetera.
Thank you. One more question, then we'll go to the audience for some commentary. But ESG investing initiatives. Barry, let me ask this of you. If your clients either requested or asked for your thoughts on ESG investing, or do they even know what those 3 letters mean?
Well, every now and then they remind me what they mean, but don't ask. This comes up quite a bit in our industry, particularly because family offices tend to be multi-generational. So not to characterize or pigeonhole folks by age, but there's an older generation that probably isn't as sensitive to ESG kind of considerations as the millennial generation might be. It's no different than in a lot of spheres of life, and trying to balance those aspects within a single family can be difficult. Typically in family office settings, there's no board. There may be trustees, but they tend to be individuals. So there's a different governance structure, and very often that governance structure has a particular identification and phone number, and that individual may have a high tolerance for accommodating the wishes of the next generation, and may not, and it's their prerogative. Typically, they're the folks who generated the wealth. That said, firms like ours have had to adapt to going from negative screens to positive identification of alternatives that fit in ESG criteria or mission-related investing criteria. We've had to get our arms around the fiduciary aspects of that, whether one is relaxing one's fiduciary duty to incorporate multi-bottom line returns in certain investments, and I would say that it's evolving very very quickly. We have not seen, or at least I have not seen in my experience, families go to full-on mission-related investing. In other words, eschew everything else, where everything they do aligns with their mission as a family or their philanthropic mission, should they have one. A great example would be environmental, where one doesn't invest in run-of-the-mill companies, only in companies that either remedy the environment or don't make it worse. It's very, very difficult to do that type of investing in today's framework. The screens are not as effective as they could be. Most companies are very complex. Many of the companies that ameliorate problems in society, like environmental problems, are small or untested, or they're single product companies. So they don't meet a lot of our typical investment criteria. So it is rapidly evolving, and as in every other aspect of our practice, it's a know your customer issue. Have a good sense of what your client wants to accomplish and try to accomplish as much of that as you can.
Thanks, Barry. Let me turn this over to Grace, because we talked recently, and Grace, you had expressed that the E&S is important, but for a lot of the companies that you follow that are foreign stocks, the G, or the governance end, is really a focal point of your practical usage. But if you could spend a little bit of time on that, that'd be great.
Yeah, sure. At the Georgia Tech Foundation, we don't really have any direct initiatives for ESG. However, we are open to active managers that adopt ESG initiatives. As a matter of fact, some of the active managers in our book, they use ESG as risk factors. So I think that's similar to the negative screening that Barry talked about earlier. So what I'm talking about here is that, for example, using environment can help a manager avoid companies that might face substantial regulatory fines because of certain environmental violations. And using as social can help an active manager identify companies that actually value their labor force. And by using G, governance, can help a manager identify companies with a great corporate governance. All these three factors have significant economic impact to the companies, and therefore can help active managers find sustainable companies. Just as Emily mentioned earlier, when we look at an active manager, we are looking for 5 to 7 years, long term. So we certainly want the manager to focus on companies that can be sustainable for long term as well. And among these three factors, ESGs, G has been the most dominant force, especially in the emerging markets. In many cases, the EM managers avoid state-owned enterprises because of the poor governance structure.
Thanks, Grace. Let me turn it over to Aon Hewitt and just ask the question if ESG is a topic within your client base.
I'll start and then I'll turn it over to Chetan. So we do incorporate an ESG screen as a component of our manager research. It is not certainly a leading component of our manager research, but it is something we talk to all managers about. I think we started incorporating that toward the middle of 2018. So in terms of clients that are interested in ESG or talking about it, I'd say that's probably 30% of our client base. We're hearing chatter. I had an email this morning. A lot of our multinationals that have a little bit more freedom outside of the US and that have implemented social governance or ESG strategies or responsible investing strategies outside of the US where it's more prevalent, like to overlay some of those same thoughts onto their qualified plans. The challenge for qualified plans, as many of you know, is that you have to prove an economic benefit. We are encouraging our clients to certainly consult with their ERISA counsel for those that are qualified if they elect to go forward with that option. It is challenging to prove that the economic benefit is the same as a standalone option, and I think you need to prove it across a variety of market cycles. But it is something we're looking at, and it is something we're looking at across asset classes.
At excuse me for jumping in, but at a conference I attended last month on mission-related investing, the leader of the conference used a term that I found aspirational, but I really hope it's true one day. And said high returns, high societal benefit, no trade-offs. And I think that that's a world we'd all like to see, but somewhat aspirational today.
Yeah, and thank you for adding the context, because I do have two clients, one Emily and I share, where they have a tobacco-free mandate, so certainly where you can implement it through a separate account. We look to see if we can apply that, and then there's another DC type of client. It's a DC plan that also has some of a relief mission-related mandate. I think it goes back to something that Emily was talking about. It's important to quantify for them. X years ago, there was a broader myth that if you invest in lack of sin stocks, you could be giving up either gain or without tobacco stocks or without any other sin stocks, you could be losing out on some return. Ultimately, what our role as their advisor is to show them in pure black and white, whether you're doing portfolio comparison, just show what the lack of overlap is between a standalone and a ESG type of an option, or option that brands themselves as such, or show them the return difference through whether it's different market cycles, risk metrics, and then show them, just prove it, whether there is a gap or not. And at the end of the day, it's, to Emily's point, it's their decision whether they really feel strongly about it or not. And within the governance framework, can they support justifying an ESG option or mission strategy that may have some of the burden or may not have some of the burden that comes with it. So that's our job, to actually quantify and show it to them and let them make the decision.
Thank you. Let's turn to the audience and see if there's some questions from the participants.
There's been a lot of research about alternatives and their true benefit, and what happened in 2018 where the correlations went to 1 seemed emblematic of what's been happening in this market, where what should happen versus theory versus what is happening don't always match. Do any of you get nervous with the standard fixed income, equity, alternatives kind of framework, and the fact that when it really needed it, it doesn't always perform exactly the way you want?
It's frustrating.
Does it get you fired?
Not yet.
I think the challenge with that, when you look at the question from a broader asset allocation, equities, bonds, alternatives, you're right, the challenge does become looking at the correlation amongst the three. What we find interesting is really peeling back the layers and looking at the sub-asset classes. And going back to the previous discussion around risk budget, and what you can and cannot do with your portfolio, looking at the sub-asset classes and trying to minimize tracking error. And the question earlier was around how's asset allocation evolved. There's been a plethora of new asset classes that have come to market that can really stand ground, whether it's multi-asset credit, equity insurance risk premium, some of the interesting type of private equity type strategies that have come to place. Looking at those and then really trying to understand what the correlation they have. Unfortunately, there's not a lot of history with some of those. They weren't around when you needed them in 2008. So all you can do is look at some of their sub-investments. But I think there are ways where some of these strategies can play a role and help you meet your objective in a risk-adjusted manner. So I think you can try to minimize some of that noise from the correlations.
And I can add on to that. And we saw in 2008, obviously a lot of high correlation there with most of our assets. Fixed income obviously did its job, but for us, we were heavily weighted towards equities, so we experienced a pretty bad down year. In response to that, we added a special situations bucket that is designed to take advantage of opportunities that would otherwise fall through the cracks in our sort of different asset class buckets, and really take advantage of opportunistic type investments when the going gets tough. And so we've had good success with that. It's been limited because since then, early on we did make a few investments that performed very well. Since then, pricing has been pretty rich on most any asset. We have taken advantage of a few situations in the oil price decline a couple of years ago, for example. Went into some credit there. We actually have some life settlement portfolios in the portfolio. We started out with some residential mortgage, whole loan, and securities, distressed assets. And so through that bucket, we're trying to achieve an 8.5 nominal rate of return in that bucket with standard deviation less than large cap equities. And we've beaten both of those objectives quite nicely so far. So we're trying to do some things that way and use some different instruments to take advantage of dislocations when they happen. We've been waiting a long time since the next real correction has happened. I thought maybe the fourth quarter might be the start of it, but that happened so quickly. All we could do was rebalance. We didn't really get to take advantage of any real dislocation in that market environment. But if that happens for 6 months to a year, I think we can probably react quickly enough. But a quarter wasn't quite enough for us.
And two more points here. The first one is liquid alternatives can be very broad. And for us, we have both long-short managers as well as diversifying strategies. We call it non-directional strategies. In that case, means that we are looking for strategies that are expected to yield equity beta risk within a range of plus minus 0.2. So ideally it should be like low correlated with equity, but Steve understands the point that when the bear market comes, everything goes down together. So the second point I wanted to add is that our team look into like all the assumptions that could potentially go wrong. Say, for example, if we are wrong about the equity premium, like how bad can that be, versus if we are wrong about the correlation about the liquid alternatives versus fixed income and equity, how bad can that be? The result was that by being wrong about the equity, the assumption is actually worse than being wrong about the correlation for the liquid alternatives. I don't know if that helps. Yeah.
I was just trying to get people to see this article that the CFA Journal had mentioned using derivatives or sales as the only ways to really reduce risk when crisis occurs. And I don't know if any of you, I know that UPS uses derivatives in some of their, but I didn't know if any of you are seeing that as a more common solution to the question about finding things that really are correlated.
Yes.
Okay.
Yeah, certainly. So we are looking to a tail hedging using options. If that's related to your question, right now for derivatives we only have futures, but it's more on the return enhancement side. It's not really helping when the recession hits, but the tail hedging is certainly very relevant, and we are very actively looking into that.
Okay.
I had a client this morning that asked if we could do a little research on a cap and collar strategy for their pension plan. I think this is an interesting question because they're concerned about potential volatility and also their return-seeking exposure. Innately, I think the first observation I have is this is a closed and frozen pension plan. It's close to 100% funded. The best thing you can do is put everything in an asset which looks a lot like your liability at that point, right? That's your ultimate de-risking strategy. And that gets you, of course, away from alternatives and into something that an insurer might want to take if the plan is terminated. But for those clients that aren't in that same situation, that are either open or that don't have a pension plan, we've done some research on something very similar to what Brad said, which is this concept of an opportunity allocation. And conceptually it's hard because how do you benchmark it, right? So, and what's your actual allocation? So within your policy statement, it could range from 0 to 10%. And then what manager do you employ, and do you already have that manager lined up pre the next crisis? So I think there are a lot of practical items to work through in implementation, but this idea or this concept of opportunity allocation would have allowed you to take advantage of the massive spread blowout in the fourth quarter, or in 2008, or when the European equity and fixed income markets sold off, or what happened with Greece and Italy and Spain and Portugal in terms of government bonds trading way through expectations. All of these could be considered an opportunity provided you have the right manager that can allocate across asset classes and across markets, and that's very challenging to find. So the concept is there. There are certainly managers that say that they can do it. I think it's also hard to benchmark, and there are some other practical implications.
Always think back to a meeting around 12 or so years ago where we were presented a hedging technique using derivatives. It was a collar-free sort of strategy, and the tax ramifications of those weren't as profound then as they are now. And I just couldn't get myself around the counterparty risk and feeling that we were trading a known for an unknown with the counterparty. And the firm that brought us that strategy was Lehman Brothers. And had we done that trade, I don't know that we'd all still be friends. So again, there are a lot of aspects of derivative strategies, and maybe now that we're in a too big to fail among a half dozen banks framework, that's not the issue that it was. But that's a lingering doubt for me, is that there's more to those strategies than the presentation would allow.
Any other questions from the audience?
Maybe a question for Grace.
Sure.
With the tech endowment fund, you mentioned the 500 areas that you're invested in.
Yeah.
Is there anything specifically in commodities?
Like energy.
Or energy futures program of some sort?
So not energy futures, but for commodity, we have energy in our private equity book. Is that related to your question at all?
Well, I think more individual commodities, like on the futures versus companies that produce commodities.
No, we do not currently. But if that is like qualified as like non-directional versus equity and fixed income, that's one of the area our liquid alternatives team is looking at. I know so far they are looking into like insurance and then other types of liquid alternatives. But if somehow they believe this is non-directional, then yeah, that's a good consideration. yeah, they can be open to that too. Yeah, if that helps. That is a good question.
One more.
This, I guess, is for the Aon folks. From an asset allocation strategy standpoint, do you see differences from a well-funded pension plan standpoint between public and corporate pension plans?
I do not work on any public plans, so I'm going to turn that over to the person that probably does. But yes, there are definitely asset allocation differences.
Yes, there is. So maybe what I can do is preface that with what may be common across the board, which goes back to this opportunity, or this opportunistic bucket, which allows you to be nimble, and that permeates broader asset pools as well. So it's not necessarily just corporate plans or public plans or ENF. So that's something I think would be something that's common. What's different, at least from a corporate asset allocation standpoint, is obviously, as you're aware, with the headlines that we've seen across various corporate plans looking to de-risk and taking the liabilities off the books and looking to a terminated status. That one has been largely driven, the evolution has been from an equity bond portfolio to a type of bond being a little bit more nuanced. As I mentioned, it was glide path, then glide path, hedge path, and now with the hedge path, it's what type of credit exposure you want, whether you want with intermediate core or long core, depending on your funded ratio. I think with public pension plans, my understanding is the dynamic is a lot different. You're not trying to hit a end game bogey, at least not in the immediate future. That asset allocation has been, generally speaking, a lot more complex, with a lot more nuanced strategies that have found their way in the portfolio. And even when you look at nuanced strategies, the implementation across that asset allocation framework has been pretty vast and diverse. So you wouldn't just give all your money to one non-US equity manager. Over there we found, or at least we've seen, as I mentioned, when you're talking about non-US, you can literally look at non-US small cap growth, small cap value, emerging markets, EM debt. So again, depending on what the overall framework is, what role that specific manager or that strategy could be playing in your overall asset allocation, it's a lot more nuanced. So simplification on the corporate side, a lot more diverse on the public side, but yet what's common is a role for an opportunistic bucket to play in each of these where applicable.
Great, thank you. Here's kind of a general thought in that we've moved away from quantitative easing to an environment where it's globally lower for longer. What are the implications of a global lower for longer environment? And let me start off with Barry.
I think our asset mix decisions over the last 10 or 12 years have largely been a function of low interest rates. And whether the low interest rates are responsible for corporate borrowing and share buybacks and driving the stock market, well, you can draw your own conclusions, but seeking returns in categories that we didn't know existed, like private market debt and mezz financing pools, and through the whole array of alternative strategies in hedge, that sort of thing, seeking returns that are somewhere between traditional stock and bond returns, but with modest variability. To me, much of that activity has been driven by low interest rates. Give me a 5 to 7% bond any day of the week. I'm going to take all the mystery out of it for a client who probably doesn't know or doesn't care what's in the black box. Very happy to have a muni credit where they can drive across that county and see for themselves if they feel like they have a good credit or not. I'll take that all day long. And I'm 64 years old. I don't know if I'll see that environment again. Maybe I'll have to hang around long enough to see where we get back to a more moderate interest rate environment.
Let me ask a question also of Brad, and maybe the thought of Does this focus you more on private markets? If it's private equity or private debt, then you might historically be.
Yeah, for us, interest rates being low has obviously driven the liability up significantly. So we have it has impacted us from a funded status standpoint, which has did have an effect on how we invest in the assets going forward, because now the liability growth is higher than it was before the interest rates came down. So we do deploy more in private markets. It's not dramatic. It's really relatively modest amounts, but it's probably in the 3 to 4% range, something like that. So it's not wholesale changing our strategy, but it is impacting it.
Turn the question to Aon Hewitt as far as lower for longer. What's the thought or implication for that?
Yeah, I agree with Brad. So to the extent that rates have been lower, liabilities have been higher, so that has a negative impact on your funded status from a pension perspective. There's also an impact on currency, and we've seen that in emerging markets, we've seen that in developed markets, and the dollar strength over the past couple of years has impacted decisions that some of your global equity and fixed income and alternatives managers have made. So I think there are rippling effects of global growth rates and 0% interest rates across Europe and very tepid inflation within the US. I come back to this point that we're long-term investors and we set our asset allocation with our clients for long-term periods, and we have done a lot of modeling and framing our capital market assumptions, and our capital market assumptions, as you might imagine, have gotten lower and lower and lower on a lot of traditional asset classes. So to Barry's point earlier, that it has caused this reach for yield, we're absolutely seeing that in the market space and in a lot of strategies that are presented to us by investment managers. Trying not to necessarily incorporate that in client portfolios that don't warrant it, but it's certainly a component of our asset allocation too. We didn't talk about return-seeking fixed income 10 years ago, right? You talked about fixed income and you talked about return-seeking equity pools and alternatives pools, and now we're talking a lot about return-seeking fixed income and mezzanine funds and things like that. And it's not appropriate to all clients, but it is certainly a component of this reach for you.
Yeah, and I'll just add, I've been focusing most of my discussion on the pension. At the Georgia Power Foundation 6 years ago, we reduced fixed income because of the yield environment, reduced it from 23% down to 15%, took a few points off of public equity, and started a hedge fund allocation as a mix, as a replacement, if you will, for the fixed income that fixed income level type of return we were getting at one point, and that proved actually to be very successful, at least to this point. So we try to make changes where it makes sense, and they're not always necessarily the same for the different pools, because that strategy just doesn't make any sense for the pension trust. We want to hedge the liabilities long duration there. So that's kind of a set it and just monitor it type of situation for us there.
Thank you. Let me turn this question to Grace. 5 years ago, the spring of 2014, what did you see personally as the headwinds of the investment framework that you were working with? And what today do you look at as the headwinds for the next 5 years?
Yeah, sure. Because I joined the foundation very recently, so I spoke to my colleagues at the foundation who have been there for a long time. And the challenge has always, the spending or the preserving for permanent capital has always been the top of our priority. So we have to be very careful about how much we spend. And when my colleagues look back like 5 years ago or even longer, the challenge was that we were not able to meet the target rate, which is CPI plus 5%. And then this is the way my colleagues said was, well, if we cannot reach the goal, we just lower the goal. So in the past 5 years, because of headwind of not being able to reach the goal, we were just lowering that payout ratio, like I mentioned earlier, from like 6% to 4.89% today. And then going forward, the challenge continues, like Emily mentioned earlier, about the lower and lower expected return going forward. And that's why I mentioned earlier that we are trying to diversify away from the equity risk and increase our budget to the diversifying strategies.
Thank you. Let me turn that same question over to Aon and kind of ask the question. 5 years ago, what did you see as headwinds, and where do you view those headwinds today?
Sure. Again, different objectives and different risks and different headwinds with different pools of money to kind of keep it in context of asset owners. Of course, with endowment foundations, it was certainly meeting the spending policy, but it was also 5 years ago, probably a number of us were saying, well, this bull market has run its course. Let's transition to a more defensive portfolio, and certainly we're still waiting for that prophecy to come true. Hopefully, keep running for long. But so the challenge at that time was understanding the macro impact that with the QE playing a role, with some of the exogenous factors that were playing a role, even the active managers that we had in our client's portfolio were struggling to add value simply because it was a momentum play, and quality stocks, for example, weren't being rewarded. You fast forward today, and no matter what pool of assets you're looking at, we're looking to, for example, evaluate managers, the focus has now become, the same thing has come back to bite us. My managers were not doing well then, they're not doing well today. Am I with the wrong managers because are these exogenous factors still there? Is something broken? Those are some of the challenges we're having with our clients, and really having them refocus on the macro, the big picture portfolio, what role your portfolio is looking to play, what role your asset allocation is looking to play, and then do you have the right managers? So we've come back a full circle in really coming back to retest their assumptions and what are their, what level of patience they have in implementing the asset allocation framework. Those are challenges I think we'll be facing the next 3, 4, 5 years, depending on where we are in the market cycle.
Great. I know that we're getting close to our time, and let me just start off with Aon Hewitt and go down the row here. And just kind of final thoughts, if you want to call it open microphone, or any thoughts that you have as far as our current environment or a little bit on the future. But
I'm standing between you and the door. And final thoughts. I do think as we look to the next 5 years, and we started talking about this in 2 aspects, risk management and ESG or responsible investing strategies. I don't think responsible investing is a fad. I do think there's a lot more research to be done. And I think that every asset manager out there is finding some way or another to put some sort of responsible investment spin on their strategies. So I would expect that we'd see more of that. You should expect as asset owners to probably hear more research from folks like us on that. And then in terms of risk management, that's probably what keeps me up the most at night, is structuring plans which have very delineated decisions and that are defensible, and then sticking to that long-term strategy over tough periods, right? So we're not in a tough period right now. We were in a tough period in fourth quarter. It's a small tough period. We were in a very tough period in 2008, and you had very different decisions that were being made at that point in time. So I would caution us as consultants, and for you all that have clients as well, just to be very thoughtful in your approach and not reach for risk. I think we were talking about that earlier. Unless it's prudent to do so, document, and then, but beware of some of the new and evolving strategies such as responsible investing.
I'll just add one thing over here. With all the different bouts of volatility that we experienced, whether it's fourth quarter of 2018 or even the rally we've seen in 2019, Our baseline thought process, for at least for our firm, has been that we are in a transitory environment where bouts of volatility will complement some of the optimism and pessimism you see in the market. So it may be prudent to come back in and retest what are your objectives, and do you have adequate, whether it's an opportunistic allocation or defenses lined up in your portfolio, such that, and then if the market turns and things change, that you have the right framework to implement those views. So those are some of the things we would start off with as we kind of discuss those, have those conversations with our clients.
Take this in a little bit different direction. Our clients and probably all of us in the room, in my opinion, ought to be concerned about the faulty income distribution and wealth distribution in our society. We work in an industry that's been blessed by bull markets for a long time and terrific tailwinds, and there's great evidence of it across the board. It's become quite fashionable politically to be part of the pitchfork crowd to come after that wealth. And who can blame folks who feel disenchanted with the way capitalism and financial markets have provided results for them over the last generation or two? Wealth divides historically, whether it was Russia or France or many other places around the world, do get resolved. They rarely get resolved peacefully. So I think that it's incumbent on us in our industry to be mindful of this. We can help our clients through cycles. We can help them with risk management. We can help them on a day in, day out problem solving basis, but I don't think we can help them when the barbarians come to the gates. So I think it's incumbent on all of us to be thoughtful and sensitive about those issues and to seek solutions without throwing out the baby with the bathwater, as some of our politicians would be prone to do. So sorry for the sermonizing, but I couldn't resist the opportunity. Thank you.
I'll add a quick comment on that and then a final thought. So I would say that part of what I believe is facing this country is a crisis in retirement planning and funding for not only this generation but older generation that's hitting retirement now. There are so many people that are just grossly underprepared for it, and this feeds over to the pension side, where we're still actively offering a pension benefit, which has been going away, and the government has created incentives to make it go away, which is absolutely, in my mind, the opposite of what we should be doing in this country. Is we should be investing more early on, providing people with a social safety net to help with the problem that Barry just described. I think if pensions were more prevalent, people would have more to fall back on, more wealth to rely on. The only other final thought I would have to say is just whether it's your pool of capital or your client, it sounds silly, but know it well and keep asking questions about it continuously. Keep checking your assumptions, your thinking around risk strategy policies. Communicate consistently with your constituencies, whether it be the committee or other internal folks, even external folks potentially, to make sure everybody's on the same page and you know what's going to happen in different environments. You can't create an environment. You cannot avoid an environment. You just need to be prepared for the different environments and have a plan in place to take advantage of that environment as best you can, and make sure everybody is on board with that in advance, so it's not a crisis moment.
Yeah, the final thoughts from me, given that we talk so much about the risk management today, there's one thing I want to add is that we value transparency a lot at the Georgia Tech Foundation. Given that we have more resources in-house now, we are onboarding a risk platform, just so that we can actually understand what risk we are taking, because public equity book is not the only place we get equity risk. The equity risk can come from many places, like that can be across all 5 asset classes. So with that risk platform, that will be able to tell us what's the risk level we are taking, as well as intended and unintended biases. With that, we will be able to see if our positioning is consistent with our view. If not, then we reallocate our capital to make sure the positioning is consistent with the view we want to express. Thank you.
Any final questions from the audience?
Question over here.
Oh, sorry.
Yeah, so I guess, can you kind of quantify the implications of lower for longer in an environment where we're hearing lower return expectations and higher risk? And this can kind of run the whole panel, right? So if we're talking about pension plans, and we're saying that we're currently in this environment, from a quantitative perspective, do you say, hey, look, asset allocation is not going, and the returns that you're going to get are not going to meet the liability growth that we've seen in the past. So from a contribution standpoint, well, hey, I'm sorry, you're going to have to pony up some more money. And now the focus shifts to, well, from a risk management and a downside protection, at least let's try not to lose as much as maybe we did in 2008. So that's from the pension perspective. From the kind of endowment perspective, again, you've kind of got that spending policy perspective, but you say, well, from a dollar amount perspective, we're not going to be able to pony up as much or spend as much from a total dollar perspective, and now maybe we have to shift the focus to more of our capital campaigns. And does that get more emphasized now from the capital campaign perspective and the spending policy perspective? And then from the family office standpoint, I don't exactly know what the implication is there, but if you can kind of shine some light on that in terms of what that means from maybe a dollar quantitative perspective.
That could probably be a conference all on its own. Let's let the panelists sit through that.
Yeah, I'm happy to jump in. So one thing I'll say is that, you know, the lower for longer sort of lingo came on the scene, I don't know, what, 10 years ago maybe. We've had tremendous returns since that point in time. And I know we're sort of borrowing from the future a little bit when we do that, but we don't know exactly what this next environment's going to mean. We could have lower interest rates going forward than we have today. That should have an effect on boosting asset prices, equity prices. You know, the GDP number in the first quarter was surprising. We could have great productivity gains still to be had. China still growing 6.5% a year. So there are places where, you know, real returns can still be had, and it's going to depend on selection, allocation, and specific manager selection, and in my opinion too, a disciplined rebalancing program to take advantage of the ups and downs in the market and capture that volatility alpha.
I think a lot of what we have to do on the family office side is manage expectations for clients, and it could be in the realm of returns and anticipated returns on a variety of categories. Where the rubber meets the road, and it's very similar to foundation and endowment work, is what spending rates are appropriate. So if someone is going to retire on X millions of dollars and use their portfolio in addition to Social Security, pensions, other things, what's an appropriate spending rate? Well, you know, early in my career, we would have said 5% drawdown year by year is appropriate, and then you know, the industry standard kind of moved towards 4%. And now I'm not too sure that 4% is a sustainable standard, because we can't earn it year by year in a sure fashion. And we have to rely on volatile markets to provide that average return over a long period of time. I think we'll hit it, but again, it's a matter of managing expectations and having clients understand that it's not possible to lock in the rate that would be ideal for them.
Same here, managing communication is so important here as well. We communicate constantly with our board. And given that they are investment professionals themselves, so they are really aware of this lower for longer environment as well. And one more thing that we do on our side is that we look at if our existing benchmark are really giving us the most opportunity. For example, for the public equity book, the current benchmark is MSCI All Country Index, that's cap weighted. So that certainly has lower emerging markets allocation than developed, and then 55% is in the US. So we are looking to that. We are actually proposing changes to our benchmark to have more weight to emerging markets, so that we can hopefully just increase the opportunities of getting alpha, given that the beta is not very attractive.
And then I'll go back to the pension side. So unlike Brad's pension, a lot of our clients are closed and frozen, so to your point earlier. In a low rate environment, it causes a decision for the plan sponsor, and that is, do I contribute more to the plan to close the funding gap, or do I try to earn it? And if, depending on your funded status, in a variety of other criteria, you make that decision. So I don't think it's a one solution fits all for our clients, but for those that are better funded and looking to minimize that surplus volatility, their asset pool is very similar to the way their liability is invested, and a similar way to the way their liability is measured. And so at that point, it doesn't really matter to me if interest rates are lower, right? Because if you're being measured at AA corporate bonds, and I'm invested the same way, I'm expecting those two pools to move in tandem. For the pension plan, which is 80% funded, and the parent company has a pension plan which is 5 or 10 times their market cap, is in financial straits, that is a very different situation, and we've had those clients as well. And in that instance, just because fixed income is lower for longer doesn't mean that that hasn't spurred growth in other segments of the market. And to Brad's point, he said they've had phenomenal returns. We have a lot of pension clients that over the past 10 years have had 8, 9, 10% total plan returns. And again, it depends on your benchmark, but other asset classes function very differently in a low interest rate environment. We've been in that for a long time. So I think the test will be whether the U.S. can keep up its very high growth rate and relative to the rest of the world, and we'll see sort of what happens over the next couple of years as relates to that.
Any other questions?
One question I have as far as when you're managing portfolio for long-term results, are you all kept up at night about concerns about the apparently ever-increasing national debt and what final ramifications might eventually come home to roost, especially if interest rates rise and the interest on that becomes exponential, and you guys are looked at as well? Do you guys have money, or is there going to be some huge inflation that's going to be done to get us out of that, or maybe they'll just keep going up without any consequence?
I worried about it a lot when it was a fraction of the current level. It's not that I've learned not to worry, but I wonder why I did.
So yes, it would be awesome to inflate our way out, and it doesn't appear that that's happened over the past 25 years, so that's a little bit of a challenge for us. I think we just had our recent PCE inflation print, and it was on the back of the strongest consumer expenditures we've had in 10 years, and it was flat. So we have a very tepid inflation environment. In terms of the fiscal deficit, I don't know if we have enough time to address that, but the Fed is doing some things, and that was a question which Joe had asked us to think about. The Fed is doing some things certainly to minimize its balance sheet. So in terms of the reinvestment of principal payments from treasuries, that's in half, from $30 billion a month to $15 billion a month starting this month. They're still reinvesting a portion of the principal payments in their mortgage pool, so we'll continue to do that. That is a component of quantitative easing, which we're all benefiting from. So I think the real issue is the fiscal deficit, and I frankly don't know what we're doing about that.
I mean, we know it exists. We don't really know what to do with that information at this point in time. 4%. I think it's 4.2% of GDP or thereabouts is up meaningfully from 10 years ago. The people, the political landscape needs to obviously take notice of that and together make something happen there and make it a focus. That's not going to be without some potential pain.
There was one last question in the back of the room.
Yeah, with the trend towards passive investing, where do you see that going, like continuing or reverting? And do you think the trend towards passive investing brings out advantages for active investing?
Okay, yeah, I agree with what you just said. That I think it does create opportunities as passive has continued to sort of nearly overtake asset management. The problem with it is obviously they tend to be market cap weighted indices, so it's a little bit of a momentum play. So we've taken some of our passive, or we are taking some of our passive approach and moving into fundamental indexing to try to solve for having too much exposure to market cap weighted indices. So that's a direct response to what we've seen happening in the active passive world.
The other thing I would add to your question with passive investing, which is certainly garnered a lot of assets, and the passive strategies have been almost hard to beat, top 30 percentile, depending on the time period you look at, top quartile as well. It's important to understand what's driving those returns. And I think one of the things we were thinking about as we were prepping for this was around the factors, what's inside those passive benchmarks, whether it's a lot of momentum stocks. And I think it does create an opportunity for active managers, because at the end of the day, when you look at the type of stocks that you expect to do well are the ones that are called quote-unquote high quality, better balance sheet. And I think one of the reasons why some of the passive strategies have done really well, and we think about what's in those passive indices, are some of the names like the healthcare, biotech names that have had no earnings, momentum play, and also the question around low rates. A lot of the companies have been able to financially engineer their cap structure and the balance sheet that's allowed their stocks to do well, so earnings have been better. So I think it's still, when you talk to active managers, as we talk to them all the time, there has been frustration that they haven't really had an opportunity to be passive benchmarks. It's been a macro environment from that standpoint, but I think they're optimistic, and so are we, that some of these quality active managers will find an environment that they will be able to add value. And I think those bouts of volatility is where they shine. And we saw that in Q4 to a certain extent, and definitely in Q1 as well, that they were able to be positioned pretty strategically from that standpoint.
I'll add one comment to it. I think it is really hard to pick good active managers. And we have this bias toward picking the manager which has performed the best over the valuation period that we're looking at. And we challenge ourselves in presentations to clients to make sure that we're not presenting just a point in time, that we're trying to present the manager's performance over a period of time, and looking at excess return correlations to their existing managers, and trying to account for style bias over time or drift or things like that too. But it comes back to the point that I made earlier. To employ an active manager, you need governance, so you need the time and skill and resources in order to select the manager. I think you need to expectation set, and managers that have performed poorly that are being profiled to you, or that you are profiling towards your clients, or that you're selecting as an asset owner. It is very comforting to pick the one which has performed the best, and you have to encourage yourself not to do that. And you should pick a good manager that has a replicable process, and that has a good solid team and a good organization and deep resources. But performance can be very misleading. And I think the second thing is with active management, depending on the strategy, we would say go high conviction and broader mandate and allow more time for that manager to affect that mandate within that. So evaluating a manager over a 3-year period or a 5-year period, I think, is premature.
Yeah, our perspective is that for passive investing, it depends on which markets we are looking at. Like we have talked about efficient markets and inefficient markets. Like say for US large cap, it has been very tough environment for active managers, even though some of them can outperform. But if you look like a net fee, like for those who outperform, like after deducting the fee, they are actually underperforming. So like Emily mentioned, it's like how we want to best use our time. So if we look at like more inefficient market, there are still a lot of opportunities, and then that passive investing would actually help a lot in those inefficient markets. For example, if you look at the China onshore markets, 80% of the transactions are driven by like retail investors coming in and out of the passive funds. That part actually created a lot of like alpha opportunities for active managers. Like based on our research, like a 10% alpha annualized in the past 5 to 10 years is not hard to achieve.
Thank you.
Let's give a round of applause to our panelists.